Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karamali, live from Yahoo Finance Studios in London. It's Friday, 12th September. Coming up on the show, global stocks hit record highs as the Fed rate cut expectations grow. The IPOs keep coming. Today we'll see how the Winklevoss twins' Gemini Space Station will perform. And there's big news for Microsoft and OpenAI. So grab your coffee and let's own the morning. Our top story today is a massive game changer for OpenAI. Microsoft and OpenAI have signed a non-binding deal for new relationship terms that would allow OpenAI to proceed to restructure itself into a for-profit company. This potentially marks a new phase of the most high-profile partnership to fund the ChatGPT frenzy. The move is significant for OpenAI as it seeks to raise capital under a more common governance structure and eventually go public to fund AI development. Remember, Microsoft has invested $11 billion in OpenAI. Under their previous agreement, Microsoft had exclusive rights to sell OpenAI's software tools through its Azure cloud computing platform and had preferred access to the startup's tech. OpenAI said under current terms, its non-profit arm will receive more than $100 billion, about 20% of the $500 billion valuation it's seeking in private markets. The companies did not disclose how much of OpenAI Microsoft will own, nor whether Microsoft will retain exclusive access to OpenAI's latest tech. The first thing you need to know about is that markets are hitting new records. Let's take a look back at yesterday's close on Wall Street, where the Dow Jones closed above 46,000 for the first time ever, and the Nasdaq closed above the 22,000 mark for the first time ever as well. That upbeat mood was carried over to Asia. The Nikkei in Japan hit a fresh record high, and as you can see, it was green across the board there. And in Europe, the FTSE 100 is looking to set another record high, brushing off news of a flatlining UK economy. So, why the new records? Well, rate cut expectations are on the rise after jobless claims rose to nearly their highest in 4 years. And even though CPI trickled up, that hasn't stopped the bets on the Fed easing next week. And the next thing to know about is that we have yet another high-profile IPO that's set to start trading today. Gemini Space Station, the crypto company founded by the Winklevoss twins, priced its IPO at $28 per share late Thursday. That's according to Bloomberg. That's above its expected range of $24 to $26, which would value the company at $3.3 billion. Since Gemini capped the valuation of the offering at $425 million, 15.2 million shares were sold. Look out for the ticker GEMI. Well, it's been a busy week for IPOs this week with the likes of Legence, Figure, and the biggest one this year, Klarna. And the last thing you need to know about is tariffs. The revenue from them neared $30 billion in August. The US Treasury Department also confirmed that July was another record month with $27.7 billion in revenue. This data comes as Beijing has urged Mexico to think twice about levying tariffs against them. Remember, Mexico said on Wednesday it will raise tariffs on cars from China and other Asian countries to 50%, a move seen by many as aiming to win favour with President Trump. Well, today it's a quiet day on the corporate earnings front, but there is some economic data to look out for. Josh Lipton has more.
All right, time now for What to Watch. Friday, September 12th. We're going to be getting a fresh read on the health of the consumer on Friday with the University of Michigan preliminary sentiment survey for September. Economists forecast that number to tick down slightly to 58, but barely change from August 58.2, signaling households remain cautious as they juggle sticky inflation and high borrowing costs. And digging into the details, current conditions are expected to edge up to 62, while expectations hold relatively steady at 56, showing consumers may feel a bit better about the economy now than about what lies ahead. Inflation expectations will also be in focus. Economists anticipate the one-year outlook to ease slightly to 4.7% from 4.8%, while the longer-term 5 to 10-year outlook is seen dipping to 3.4% from 3.5%. The new consumer data providing another piece of the economic puzzle as the Fed contemplates its next move, with interest rates ahead of its September FOMC meeting. With tariff uncertainty and a cooling labor market in the background, This report could set the tone for markets heading into the weekend.
Well, let's get more on what to expect later this morning. Well, I'm joined by Jeremy Stretch, Chief International Strategist at CIBC. Jeremy, thanks so much for joining us. Well, let's start with the sentiment data that's out later this morning. We should expect that to really shift the dial in terms of where the Fed will go next week, should we?
No, this is the final piece of key data one suspects before the Fed decision, although one would be very surprised if it were to change market pricing ahead of next week's policy decision. We have more than a full 25 basis point cut priced, in particular after the weakness that we've been seeing in the various labour market indicators over the course of the last couple of weeks. We could argue that the jobless claims numbers that we saw yesterday were slightly distorted because of Labor Day and or potentially flooding in Texas, but nevertheless, the trend of labour market dynamics favours those rate cuts to continue to come through. And of course, that's been supporting that earlier story you were talking about in terms of those record closes in terms of the equity space.
But Jeremy, the labour market might be guiding us towards Fed cuts, but inflation, though, I mean, the data that we saw this week, aren't you worried that perhaps prices do still remain a bit sticky?
Well, it is true that prices remain sticky. I think it was quite notable when you looked at the CPI print that if you looked at food prices, they were up 0.5% month over month, and the US is a net food importer, and that underlines the potential tariff-related impact there. Also, core service prices, which had been heading lower previously, have somewhat stalled. So yes, there are some concerns regarding the inflation backdrop, but you have to remember that the Federal Reserve, unlike most other central banks, does have that dual mandate. And so in a sense, I think that underlines the fact that the Fed will be focusing rather more on that employment dynamic and trying to maintain full employment a little more than worrying about inflation. Although the inflationary risks are still there, they haven't amplified in the way that certainly most would have anticipated earlier in the year. And I think it's worth just coming back to that Michigan Sentiment Survey. There is an inflation component within that. And of course, that was one of the signals that was flashing red earlier in the year, but those red signals have gradually dissipated.
Now, Jeremy, I know you as a bit of a currency guru. What do you make of where the dollar's going? It's not had a great 2025, though it's seen some sort of positive sort of comeback in the recent months.
Well, I think that the dollar is still very much set fair for further weakness. And now the question is this happy to be tolerated by the US administration? I think ultimately I would say yes. Yes, they may talk about maintaining a strong dollar. Well, what they really mean is the international usage of the dollar and importantly, being maintained as a reserve asset. But ultimately, they're quite happy for a cheaper dollar because, of course, that helps US exports, makes imports even more expensive, even beyond the tariff dynamic. And I think as the US sort of growth exceptionalism that's really been evident over the course of the last few years dissipates, and or the other structural challenges in relation to the Fed come to the fore, then I think it's likely that the dollar's valuation will continue to depreciate over the course of both this year, but also into 2026 as well.
Now, I want to talk about the Federal Reserve and the threat to its independence, possibly as well. We've got news, that President Trump is trying to push ahead with a decision on the Lisa Cook firing that he wants on Monday. He's also pushing for Stephen Miron to be put in place by Monday as well at the Federal Reserve. What do you make of all these moves? How worried are you as someone in the markets?
Well, in a sense, what I just said in the previous answer was talking about structural issues. And in a sense, that was the argument or that was the focus of some of those concerns, because clearly Fed independence is very much on the table. If Myron is approved and or Cook is taken away from the Fed board sooner rather than later, then there may well be an opportunity for the Trump appointees to start adjusting not just the strategy of the Fed, but also the membership of the Fed regional president. So there is a structural risk that the US monetary policy could be besmirched by political interference. And that, of course, is the sort of factor which will create uncertainty. And that's a reason why investors will continue to be somewhat more nervous about holding US assets, or at least maintaining them in the way that they've done previously. So we are seeing an increasing number of investors hedging their US dollar exposure, and that is causing and will amplify additional dollar downside.
Jeremy Stretch from CIBC, many thanks for your thoughts.
Thank you very much.
Okay, it's time now for a short break, but when we're back, we'll tell you what a Fed cut will mean for your money. Welcome back. Well, as we just discussed, all eyes are on the Fed as a rate cut is widely expected next Wednesday. But what does that mean for you and for your interest rates? Well, Yahoo Finance markets and data editor Jared Blickery has you covered with the latest episode of Stocks in Translation.
Everyone expects the Federal Reserve to cut rates next week, but what does that mean for mortgage rates and stock prices? Markets have not been following the typical playbook since the Fed started cutting 1 year ago, and that's what we're diving into on today's Stocks in Translation. First, why do these longer-term rates matter to you? Mortgages track the yield on U.S. government 10-year Treasury debt, the so-called 10-year yield. And consumer loans like auto and student loans, they follow bond yields too. Higher yields mean pricier borrowing for companies, and they can cause employers to pull back on hiring new workers. And when yields move higher quickly, that can weigh on stocks. It's not always the level of rates. A lot of times it's the speed of the move that shakes up Wall Street. And here's a chart of the U.S. 30-year yield going back to the beginning of the year. You can see it's moved sharply down toward the right edge, and rates have indeed been falling the last couple of weeks, but they're still quite a bit higher from when the Fed started cutting 1 year ago, not necessarily on the chart. So why are long yields net up when the Fed is supposed to be cutting? Well, first, it's simple supply and demand. Uncle Sam is borrowing more money than ever, and that means higher supply of the bonds it sells to raise money to spend. In other words, big deficits equals heavy Treasury supply. And then there's something called the term premium, which is just a fancy way of accounting for uncertainty. And there's lots of uncertainty right now. Creeping inflation, it's also a big part of it, and that means tariffs and energy costs are factors. And finally, we've got long-term yields surging around the world. It's not just a US issue, this is global. Now remember, Fed rate cuts do not guarantee lower long rates. Todd Sohn over at Strategas ETF Research studied what happens over the last 10 times that the Fed started cutting rates, including the most recent in September of last year. Since 1975, longer-term rates went lower in 8 of these last 10 cycles. And that's what usually happens, but not in 1995 when there was a small rise, and not in the most recent cycle. In fact, instead of falling and following the Fed's short-term rate move, the 10-year yield surged over 100 basis points. That's a full percentage point that translated into much higher mortgage costs. So the translation here is that the Fed can cut the front end, but that does not necessarily control the long end. And I should quickly add here too that the Fed does have tools to directly rein in those longer-term rates, but that would be an unusual step for them. And here's what you want to watch over the next few weeks and months. First, at the next week's Fed meeting, you're going to watch the size of the rate cut, which is expected to be just a quarter point. If they go for a double cut, that could really stoke longer-term rates, as price inflation could theoretically head higher. And really listen to Chair Jay Powell as he talks about inflation. Those comments matter. And then we're going to want to monitor the U.S. Treasury auctions, how they go, and along with any reports about future borrowing. Are foreigners, are they still scooping up U.S. debt? Then watch for news about tariffs, especially from the Supreme Court, which could strike down many existing tariffs. That and any hints of stronger than expected inflation. And for what it's worth, longer-term yields, they went a little lower after the latest CPI move, so no big threat there. Bottom line, don't assume cuts drop your mortgage. The long end listens to deficits, uncertainty, prices, and also global flows. We're going to keep you posted on next week's decision and those Treasury auctions after they hit the tape. And tune in to Stocks in Translation, the podcast. For more jargon-busting deep dives, new episodes can be found on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Well, let's take a quick break now, but stay with us for trending tickers and a closer look at how Oracle makes money. Okay, imagine this. Superman, Harry Potter and Indiana Jones are all moving together under the same roof. It's not a fictional storyline, that's a real scenario in today's world. Paramount Skydance is reported to be preparing a majority cash bid for Warner Brothers Discovery. Shares of both companies closed nearly 30% higher, as you can see here, and they are still moving up this morning, with Warner 4% higher ahead of the US opening bell. The surge comes on the news that after completing its own merger, Paramount Skydance is putting together a cash offer for Warner, backed by the Ellison family. By the way, Skydance is run by David Ellison, the son of the billionaire co-founder of Oracle, Larry Ellison. Now, if this deal between Warner Discovery and Paramount Skydance materializes, the combination would unite some of the biggest names in media: Warner Brothers Movie Studios, CNN, DC Comics and HBO, alongside Paramount Pictures, CBS, Channel 5 in the UK, and networks like MTV and Comedy Central. Analysts say such a tie-up would reshape the US streaming landscape, creating a streaming giant that could challenge Netflix and Disney. But with that kind of scale, expect antitrust and regulatory hurdles. Okay, next up is Adobe, who seem to have avoided the fate of many other software companies that have seen shares plunge in recent weeks. Shares were up about 3% in pre-market trade after the company reported better than expected Q3 results. Revenue rose 11% year on year to $5.41 billion, and net income climbed to $4.18 per share. Adobe has had a tough year so far, but looking ahead, the company raised its full-year growth forecast, touting a successful AI push. Investors are rewarding the strong demand story, even if the competition from the likes of Canva and Midjourney, Figma and others in creative artificial intelligence tools remains heated, to say the least. Finally, we stay in AI. Let's take a look at one of NVIDIA's main suppliers, SK Hynix. The South Korean memory chip maker's shares surged after it announced that it's ready to begin mass production of its next generation high bandwidth memory chips called HBM4. The technology is crucial for AI computing and is already used by NVIDIA. SK Hynix said it has completed all internal validation and quality checks, clearing the way for full-scale rollout. Earlier this year, it said it had already shipped samples to customers as it sought to outpace rivals Samsung Electronics and Micron. And speaking of Micron, it's worth noting that the stock also closed up significantly yesterday, thanks to some analyst upgrades. So, demand for AI hardware and infrastructure is skyrocketing, and we are now clearly seeing some beneficiaries. Notably this week, you've probably heard about Oracle. Look at the stock price. Although it lost some ground yesterday, it's still up nearly 40% in 5 days. So as we wrap up a record-breaking week for the company, we bring you a closer look at how Oracle is actually making money. Yahoo Finance's Josh Lipton and Corey Johnson, host of the Drill Down podcast, have the details for you.
We saw an amazing quarter from this company, the likes of which we've rarely ever seen from any company. I can't think of anything I've ever seen at this scale that was so ginormous of an upside surprise, not to the numbers of the movement of the stock, but the change in the scope of a very, very large business. The only thing I've ever seen like this is NVIDIA about 2 years ago. It was really an amazing thing to watch. And it was, in this case, it wasn't orders, or it wasn't at least numbers that we saw in terms of bookings on the balance sheet. It wasn't, or certainly not the revenues they recorded, although the quarter was very strong. It really is that RPO number, those remaining performance obligations, that the orders that they have in hand were just jaw-dropping in their size on the heels of another quarter where I would have said the same thing, but this is just orders of magnitude bigger.
I want to take a beat here, Corey, because folks who are listening, not everybody might fully understand what Oracle does, appreciate what Oracle does, which is understandable. As a shareholder, as a believer, why don't we take a beat here for a moment, Corey? Just walk us through, what does Oracle do? How do they make money? And how has the company evolved?
It's a great question, because it really has been changing for at least 10 years. And I think that the company has talked about it a lot. There have been a lot of skeptics. I've been one of them over the years when they've talked about moving from licensed software to the cloud in the face of a lot of attention that their competitor Salesforce was getting. And there were criticisms saying, well, is this really cloud revenues? Are they really lumping all this stuff in here? Where are they truly embracing distributed software? And what we can see now over time is that they've embraced that as much as anyone has ever done this. So their cloud business is fantastic. And their cloud business has different aspects to it. So yes, it is software and software delivered as a service. It's also infrastructure. That is the use of data centers. Infrastructure as a service is a huge business for them, and the thing that is growing so fantastically. There you have it, this wonderful graphic showing us they had $3.3 billion in infrastructure as a service revenues, in addition to software as a service revenues of $3.8 billion. And that is a change in the way that they used to manage software. But the software business that has been core to Oracle since its earliest days in the 70s, yes, the 70s, is now taking a back seat in terms of attention and certainly in growth to what they're doing with infrastructure, what they're doing in building data centers, where this is a company that is, yes, they've got a hardware business and they've trimmed that to make sure they've got the right offerings, which is a very small business, but the renting out and the construction of data centers just been an incredible business for them that they have fully embraced to the point where one could argue they're right up there among the leaders there of building out these data centers for their customers.
Let me ask you, Corin, that great cloud computing fight, we talk about Amazon and Microsoft and Google. Where now is Oracle in that fight, now and looking ahead?
We'll see over time. There's different market studies out there. They're certainly playing catch up to the likes of Amazon Web Services and Microsoft Azure and Google Cloud Services. But they're clearly a contender here in this business. And what they're doing that's so much different is they really are building out data centers in an aggressive style and with a kind of a modular approach. This is something Larry Ellison has backed away from kind of larger management of the company and taken this role of founder of the company as chief technical officer, has really talked a lot in the conference call about the modular nature of their data centers in two ways. One is that regardless of the size, small or big, in the data center they're constructing, they are all running the same kinds of stuff so that a customer can go from a small data center to a big data center and find what they need in Oracle's offerings, or Oracle can build it for them. Then secondarily, they're reducing the size of all of the Oracle offerings so that it can be really all held on a singular rack or a singular set of components that will allow customers to get the same plug-and-play experience in any Oracle data center, including all of the Oracle data products, to allow Oracle to sell everything they have on a software standpoint to anyone using any Oracle data center and on any service, whether it's at an Amazon data center or at a Google Cloud data center. They've really homogenized across all of these offerings.
Okay, before we go, let's have a check-in on where US futures stand before the opening bell. And it's fair to say maybe there's a sense of caution before we get the consumer sentiment data out later, and perhaps maybe traders scaling back their bets, being so aggressive about the fact that there will be a Fed rate cut next week. So a little bit of caution there. Let's have a quick look at Tesla as well. I wanted to show you this yesterday. Shares were up over 6%. That's on the Fed rate cut, but also the fact there's some growing optimism about robo-taxes. Okay, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.